Welcome to The Explainer. Today, we're jumping into the wild story of a brand new stock, ticker FOFO, that just had one of the most explosive market debuts you'll ever see. Take a look at this number, 466%. I mean, that's the kind of gain that makes even seasoned traders do a double take. But the number itself is only half the story. That's right. This wasn't over a year. This happened in just 10 trading days. We're talking 2 weeks. It's absolutely nuts. So the big questions are, how on earth does something like this happen? Is it for real? And what are the pros thinking is coming next? Well, we're going to get into all of it. Let's start digging.
All right, first things first. Before we can even guess where this stock is going, we've got to get a crystal clear picture of how it got here. So let's lay out the facts. Just look at this timeline. It all starts on September 12th, debuting at a totally normal $5 and change. Fast forward less than 2 weeks, and it closes near $30, after touching almost $32 during the day. This wasn't just a climb, it was a rocket launch.
You know, a move this massive doesn't just happen by accident. It's a huge, flashing neon sign that says a ton of money and attention is pouring into this stock. It's basically the textbook definition of intense speculation, with traders piling in, betting the ride isn't over yet. So when you're investigating a stock move this big, where do you start? You follow the money. And in the market, the easiest way to do that is to look at the trading volume. And here's why volume is so important. It tells you about conviction. See, when the price is going up, and a whole lot of shares are being traded, it's not just noise. It tells analysts that investors are confidently buying in and holding on, or what they call accumulating shares. And you can see it right here in the data. Look at debut date, almost 9 million shares traded hands. Then, on those big jump days, September 23rd and 25th, you see these huge spikes in volume again. Every major leap in price was fueled by a tidal wave of buying. This was a very, very loud rally. Okay, so that's the first clue. Now, to go deeper, analysts break out their toolkits. They use things called technical indicators, which are kind of like a secret decoder ring for the market, helping translate all that price and volume data into a story we can actually understand. And one of the most basic but powerful tools is the moving average. I love this analogy. It's like smoothing out a bumpy road. It gets rid of all the little up and down noise, so you can see the actual direction the road is heading.
Now, here's the key. Look at the difference between these two numbers. The exponential moving average, the EMA, is higher because it pays more attention to what's happened in just the last few days. And that gap between the two is a huge signal. It's telling us not only is the stock in an uptrend, but that upward momentum is actually getting stronger. It's accelerating right now.
But, and this is a big but, here's where we get a little plot twist. There's another tool called the stochastic oscillator. Think of it like the tachometer in your car. When it's pushed all the way into the red zone, you know the engine is putting out max power, but you also know it can't stay there forever without overheating. And that is exactly where FOFO is right now. Its reading is 87.42. Generally, anything over 80 is considered overbought. So this is really our first major red flag. It's a warning that even with all this incredible strength, the rally might be getting ahead of itself and could be due for a break. But hold on, because despite that one pretty serious warning sign, almost everything else is still flashing bright green. All of these other indicators you see here, the PSAR, the Chaikin oscillator, the OBV, the VWAP, they're all basically saying the same thing. The powerful uptrend is very much intact and big money is still flowing into the stock. So the evidence, on balance, is still overwhelmingly bullish. We can even look at this with straight-up statistics. Linear regression just draws the best fit line through all the recent prices. And the result? It perfectly captures this whole story. The slope is super steep, confirming the powerful uptrend. But look at that deviation, over 41%. That's huge. It means the stock price is flying way, way above its own trend. It's pure strength and extreme volatility all rolled into one. So what do you do with that? You've got this incredibly powerful trend, but at the same time, you've got these warning signs that it's overstretched. Well, this leads analysts to map out 3 pretty distinct paths for what could happen next. All right, so scenario 1 is the bullish case. The momentum just keeps going, it smashes through that recent high near $32 and makes a run for 35. Scenario 2, the bearish case. Enough people decide it's time to take those massive profits off the table, and the stock pulls back to find some support down around 18.
And then there's a third option. It just goes sideways for a while, bouncing between those two levels while the market tries to figure out its next big move.
But for the very next trading session, the momentum is just so strong that the consensus is it's likely to open higher. It might even gap up, which is when a stock opens way higher than where it closed the day before, leaving a gap on the chart.
Okay, let's put it all together. Let's synthesize all this evidence and see what the final verdict from the analysts really is.
And honestly, this single quote from the analysis just sums up the whole situation perfectly. You have this extraordinary bullish trend. No one can deny that. However, you have that one indicator screaming that the stock is in overbought territory, which is often a precursor to a fall. It's a classic conflict. So if you're going to remember anything from this, here are the 4 key takeaways. Number 1, the upward momentum is real and it is incredibly powerful. 2, those overbought signals are a serious warning that shouldn't be ignored. 3, because of the extreme volatility, this thing could turn on a dime and reverse just as fast as it went up. And that leads to number 4. For anyone thinking of trading this, risk management isn't just a good idea, it is absolutely everything. And in the end, it really all comes down to this classic battle you see in the market all the time. You've got momentum on one side. An object in motion stays in motion. And you've got gravity on the other. What goes up must eventually come down. The big question for FOMO is which one of those forces is going to win. And you can bet everyone is watching to find out.